To identify the strong zones in the market, you should look at the hedging zones of market makers. The hedging zones of market makers are areas where, when the stock price reaches a certain level, market makers are forced to buy or sell the underlying asset to manage their risk. The moment they execute customers' option orders to avoid exposure to directional risk, they make trades in the spot or futures market that are opposite to their positions. In other words, if you can identify the hedging zones, you can pinpoint the market's critical points and recognize the areas where price reactions are likely to occur easily. Now let's take Bitcoin as an example. The screen shows the Bitcoin options Gamma dashboard. The first tab displays the pure strength of calls and puts by strike price. Currently, there is a large position in the 75K put options, and there is strong selling pressure in the 80K call options. If Bitcoin is to break above 80K, market makers will need to buy a large amount of Bitcoin spot and futures to hedge their short call positions. Conversely, if the price falls below 75K, they will have to sell more Bitcoin to hedge their short put positions. The second tab shows a pie chart version of the first chart's data, and similarly, there are many put options held by market makers around the 75K and 70K levels, with a significant number of put options also at 82K. Since market makers take the opposite position to retail investors, these are put short positions. At 82K, retail investors have bought a lot of puts, and market makers have taken the other side by selling those puts. If the price reaches the 82K level, market makers will be forced to buy the underlying asset to hedge their put short positions. In other words, if the price surpasses 82K, the market could experience a significant rally due to a squeeze. The price levels we need to pay attention to are the 80K short call resistance, the 75K level, and the 70K support line. There is also the 80K level, but since it's more like a wildcard area, we won't focus on it too much for now. If we mark these areas on the chart, we get these three zones. Returning to the dashboard, if you look at the third tab, you'll see a single green line drawn. This section represents the gamma exposure by expiration date. When the green line spikes high, it means the market is stable, and the closer it is to the zero line, the greater the volatility. When it's at the bottom, that's when hedging activity is most intense, so the market movement on this date is the most important. The dates you need to pay attention to right now are the May 24th and June 5th expirations. If you look at the Bitcoin options chain for May 24th, you can see the implied volatility. Implied volatility is a statistical indicator that shows the realistic range of price movement. Based on the current Bitcoin price, statistically, it is most likely to move plus or minus a certain dollar amount. You add and subtract this plus minus value to the current price to calculate the expected expiration price and mark it on the chart. The current price is 77,830 and the lower value is 2,075 minus 2,075, then 75,755. Now, let's mark this value on the chart. Okay, I've marked it on the chart like this. Now let's calculate the upper value in the same way. So the current price is 77,816 plus 2,135, 79,951. If you mark it, you'll see the expected range until expiration, and the upper hedge zone overlaps with the implied volatility zone. Since this is likely to act as strong resistance, all you need to do is watch to see if it reaches 80K by this week's expiration. Lastly, the fourth tab is gamma exposure, an indicator that shows whether market makers are currently suppressing market volatility or increasing it. If the green line drops to the zero line, it means volatility is increasing, and if it rises above the zero line, it indicates that volatility is being suppressed and the market is in a stable state. If the market remains stable even after reaching 80,000, further upward movement is possible. However, if a downward trend appears at 80,000, the market will decline due to being blocked by short call positions. Looking at the chart, the market is moving steadily within a box, but the real movement happens near 80,000 or 75,000, so you can ignore all the minor noise that occurs in between. Now, just knowing these major levels can significantly increase your trading success rate.